Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to give you easy to understand evidence-based holistic insights to help you master the game of building wealth. And before I get into today's Q&A episode, thanks to an idea of Campbell, we thought we might begin not every Q&A episode with a preamble, but at least some of them where there's some more timely information to share that, on topics perhaps that might be sort of current events, but also could be situations that we've come across that might not be big enough to do a Wednesday topic, dedicate a whole podcast to, but still worth mentioning and sharing. So we might build out this Q&A episode a little bit to include some of that commentary. And the thing on most people's minds at the moment, and certainly there's been a lot of press about it, is the budget that's coming up. Of course, the budget will be delivered on the evening of Tuesday, the 12th of May. And, there's a lot of talk around changes of capital gains tax, capping of negative gearing potentially, these sorts of changes that, of course, investors are going to be concerned about, particularly if there's no grandfathering, which means that they're going to apply to everyone. And we're getting questions from clients around, well, what do we do about this? Is there anything we should do prior to it? And so on and so forth. So let me just talk about that initially today before I get into the first question, which is a long one from Wayne. Well, the first thing is in terms of our plans. So on the evening of the 12th, I will, and always have for many years, write a succinct, clear, easy to understand summary, hopefully, of the changes. So that's the sort of first port of call. We will include the link to that blog in our normal Wednesday email. So 10:30 the following morning, you'll have the link to that blog, although it's probably going to be posted on the website. I normally finish around 9 or 10 o'clock, depending on what's going on. So that's the first thing is you'll get a clear rundown of what the changes will be. We will soon be sending out an email invitation to a live Q&A YouTube event that Mina Abraham, who is my co-host in the Holistic Accountant podcast and leads our tax and business advisory business. So Mina and I are going to do a Q&A. We'll probably spend so that's on the Thursday, the 14th of May, 12:15. We'll do it for probably around 45 minutes, so 12:15 to 1 o'clock, hopefully over lunch. You can have a listen, and we'll probably, we don't know what the changes are yet, right? So, it's difficult for us to say what we're going to talk about, but I imagine we're going to probably spend the first little bit of that presentation talking about the changes and our views on it, and then answering some questions. So when you get the invitation to register for that event, you've got an opportunity to post your questions. Again, that's difficult to do given we don't know what the changes are. But anyway, we'll have a go at it. And then, of course, if there's questions live, we can answer them there. And then beyond that, those two bits of content, well, let's see how we go. We haven't planned out to do anything beyond that, but I'm sure we will, depending on the changes. So no need to panic about these changes, I don't think. I think they're not necessarily going to be welcome, but I don't think they're really going to probably move the dial. And I say that not knowing what the changes are, so take that with a grain of salt. But no need to panic. There's always a solution or a way to navigate many of these sorts of situations so you don't end up having to throw your complete investment strategy out and start again. And also, the other thing to really recognize is on Tuesday, 12th of May, the government will propose what they would like to do. If it's something like a change in the CGT discount, it will have to be legislated, which means it's got to go through both houses of parliament. So what is proposed on that Tuesday evening won't necessarily be what will become law. And so we're certainly advising our clients, don't react to anything until it's law, firstly. And so it's really just what is proposed at that particular stage. So just want to give you that preamble. We are on top of it as a part of the Investopoly community, as a listener. We will make sure we'll keep you updated and certainly share our best sort of insights and thinkings to navigate what is expected to be some significant taxation changes. Whether they end up being that significant, time will tell. But anyway, So keep tuning into the podcast and we'll certainly help you through as best as we can. I mean, this is not advice, it's only information only, of course, but as best as we can through these changes. Okay, let's get into the first question, as I said, from Wayne. It's a really long one with a very detailed spreadsheet. And look, I often comment, Cam and I probably both comment that, look, more information is better in these questions. So I'm certainly not complaining about the amount of information, but sometimes it's difficult to make an assessment or provide a sort of commentary on someone's strategy when you do have so much information, because you really actually need to do some financial modeling. I mean, that is really the core of, one of the core things of financial planning. One of the most important, I guess, tasks that we do as a planner in order to formulate advice. And of course, I can't sit here and financially model. First, I don't have all the information, but financially model each individual question. But I'll give you a little bit of a rundown. Wayne and his wife are 50. They want to retire at 55. So that's important, 5 years before they're able to access super. They've got 5 investment properties and a home. They would like to go and buy a apartment down by the coast. Actually, they mention Mooloolaba, Maroochydore, or Wollongong in New South Wales, so the Queensland and New South Wales along the coast. And that apartment's going to cost north of 3. Their house is currently worth about 1.5, so there's a bit of a gap there. And as I said, they've got 5 investment properties worth just about $4.3 million, with looks like all debt is offset. In terms of super, they've got, wife's got 700, Wayne's got 560. So what's that? 1.2, 1.3, close to 1.3 mil in super. And so Wayne's plan is to divest of the properties and contribute the equity into super to maximize the transfer balance cap, which, I've spoken about here, the transition from borrowing to invest in property and using compounding capital growth and leverage to really build your asset base, and then really tilting then away from property to more liquid assets in an environment such as super that's going to be more tax effective. So certainly that seems, on the face of it, a pretty good idea. The interesting point here, I think, is, when to sell. And, Wayne's talking about getting non-concessional contributions in, potentially while he's working. I think he can do that from just surplus cash flow and then start selling property in 2031. So in about sort of 5 years or so when he retires. The thing about property and borrowing to invest, and this happens quite often, as I said, Wayne doesn't have any debt, but essentially he does have debt. It's just fully offset. And that's something that we sort of advise mostly our clients to do. So rather than pay down the loan or pay out the loan, just offset the loan. Gives you some flexibility to either access and redeploy that capital, and also increases your liquidity as well. So I guess my first observation is, yes, let's get the money into super, but whether you start selling property from 2031 onwards is more a question of, to my mind, not financial imperatives so much, but more a question of how the property is going and future expected returns. Because what Wayne could do, in fact, is he could just start spending the offset monies. So no need to really sell any of these investment properties, probably, maybe not at all, potentially. Putting aside, the desire to get more capital into super, put that aside for a second, because he doesn't need to necessarily do that by age 60. He can get more and more money inside super at any stage, even in his 60s. So we don't need to race to 60 and hopefully have our transfer balance caps fully utilized by age 60. That's kind of nice if you can do it, but it's not imperative. It's just in our strategy, we want to have a way of making sure we are going to use the transfer balance caps. Remember, the transfer balance cap is the total amount you can have inside super per person that's going to be tax-free. And it's $2 million today. It's going to be $2.1 million after July this year. So really, in Wayne's situation, we want to have $4 million at least inside super, if we're talking in today's dollars, just to make sure that we're not going to pay too much tax or minimize the amount of tax we're going to pay inside super. So Now, you could argue, but yes, Stuart, if we keep the investment properties post 60, we're paying capital gains tax outside super. And as I said at the beginning of this episode, who knows what that capital gains tax looks like. So I acknowledge it's not as tax effective, but I guess it's really looking at after tax returns. And if you've got some property that's going gangbusters, even though you're going to pay some CGT on it, the after tax return still might justify holding on to that. So that's the first thing I would think about. And also the other comment I want to make is around timing of these sorts of things. You need to make sure you've got plenty of flexibility. So for example, if I'm speaking to Wayne today, I know let's start selling property. He's got 5 properties. Let's start selling property, maybe one a year, maybe not as aggressive, but one a year, let's say 5 years from now. I know from my experience in dealing with clients, that might not always be the best thing to do. Come 2031 might not be a great time to sell assets, or there could be a change in personal circumstances. So you do want to have plenty of flexibility around the implementation of that strategy. And in fact, you might start selling, 2040 Wayne 65, for instance. You need to be able to say, if I need the flexibility to not sell, what am I going to do? How am I going to fund retirement? Will I just run that super balance down a little bit more aggressively than I otherwise would have? Which is fine. That could be an answer to that question, but you certainly want to have that flexibility in order to do that. Wayne did mention that one of his concerns was CGT. Well, I mean, if it's a concern today, in April, it's probably going to be more of a concern next month, just because obviously CGT is increasing. Look, no one wants to pay CGT, but the difference is, I mean, at the end of the day, if your effective rate of CGT is as high as 30%, and it's probably not going to be, you've got to be realistic. You're still keeping 70% of the gain. Now, I know you've done all the hard work in terms of hang on to the property and fund the negative cash flow and pay down the loan, do all those sorts of things, but it is what it is, and you've got to pay some tax somewhere along the line, whether you pay it or your estate pays it, but it's hard to avoid it in totality. The other thing too, as a observation, and it's something in fact Campbell and I were talking about over lunch today, is that there is a optimal level of gearing that some investors would be worth considering maintaining throughout potentially most of their life. So even into retirement. So Wayne here has repaid all his investment debt against the investment properties, I guess in preparation for early retirement. That's fine. But if I was in Wayne's situation, I probably wouldn't have been that aggressive. As I said, he's got 4.3 mil of investment property assets. If I had about a mil of net debt, or even 1.5 of net debt against that portfolio, I'm pretty comfortable still. I'm not uncomfortable with that. So maybe looking at Wayne's situation, maybe he would have been better off over the last 5 years putting more money into shares. He doesn't have, by the way, any money in shares in personal names. So he's got no share portfolio, but he's been trying to get money into super. So I'd still do the super 100%. There's no dramas there. But I guess there's a balancing point at some point between, am I reducing my gearing level against property to a level that starts to become inefficient? So 0 gearing, for instance, and foregoing other investment opportunities. And as I said, Campbell and I were talking about this at lunchtime because we were approached by a prospective client that has amassed a significant amount of wealth. And we knew this client, we came across this client, who I want to say like 7 to 10 years ago. And that client had a lot of debt at that stage. So spent the last 7, 10 years repaying that debt. I'm not sure that was the best approach or the most optimal approach. Having a nice level of, personal equity and debt is actually quite efficient and, allows you to sort of balance out assets as well. For instance, if Wayne had have been making maximum non-concessional contributions for him and his wife, by drawing down the offset account, it actually spreads the time in which he can get more money into super rather than, using more of that capital repay debt outside of super. The final piece of the puzzle with Wayne's situation is, and I thought it's a really complex, I don't know what I'm going to say in response to this question, but I've prattled on for nearly 10 minutes already, so I need not be concerned about my ability to talk a lot of nonsense. But anyway, I surprise myself sometimes. Anyway, the other factor here is what to do with the apartment. So he's mentioned, he wants to do this upgrade, wants to go to Mooloolaba or Wollongong or something like that and get a nice apartment with obviously coastal views probably, and do something like that in preparation for retirement. Should he buy that now? The thing here is, if I was in Wayne's shoes, the thing that I'd be thinking about is I'd be doing a lot of research. and trying to identify probably only a handful of buildings that I would want to be in. And those handful of buildings, you want to think about things like the age of the building, the amount of maintenance that needs to be done, how well the owner's corp is being managed. Are they actually keeping that building up to speed? Is the management really good? And then obviously then the quality of the apartments in that building, and then the aspect. Because that's the key thing here, I think. If I'm in Wayne's situation, I'm going to spend 3 mil on an apartment in those locations. I want it to be great. And I might even go, look, I'm happy to spend 3.5 or even close to 4, as long as all the numbers work, to get something that's really unique. Something that's great aspect, great views, in a building that, has higher ceilings, that gives you that sense of sort of greater space or better amenity in the building, whatever it might be. There can be lots of different nuances with these things. But what I wouldn't do is I wouldn't try and, I don't want to, I was going to say I wouldn't try and minimize the budget. So what I wouldn't do is set a hard budget of 3 mil and then compromise. I would want to buy something that's really great, just because it's always a great plan B. Not only will it have the lifestyle amenity, and after all, that's what you've worked hard to get yourself into a position to enjoy, that amenity. So not only will it have that, but also it will mean that it's going to outperform, or at least if the rest of the market drops, it's going to drop by less because it's a better quality asset. And with apartments, it's really all about views, and then it's really about the building. So, what does the building look like? How robust is it? How well is it managed? These sorts of things. So, Wayne, if I was in your situation, that's what I'd be thinking about. And so what you need to then do is say, as I said, I reckon there's probably, when you really get down to it, maybe only 5 buildings in those locations, across those locations you mentioned, that you'd consider. And then I think what is going to happen, or the situation, is that you're probably going to need to act when an opportunity arises, as opposed to say, oh, look, I'm going to sell my home in 3 years, 5 years, whatever it might be, and then I'll look. That's possible, and that would be more ideal financially, and I'm not dissuading you from doing that, but I think it's more about strike when the timing is right, when that great asset comes up. That you can't plan for, but I think taking that strategic approach around that building is probably the best way to go. So thanks for your question, Wayne, and sorry it's taken us a couple of months to get to it. Okay, next question is from an anonymous listener. That listener is asking about, he listened to an episode back in 2018 on live vesting, which was sort of my take on rent vesting, which is, go and invest in property and rent wherever you want to live. This listener is talking about retire vesting. We're making up words now, which is really go and buy the investment property and occupy that investment property down the track as your home. And wondering, how do I make that work? How does that all work? Well, the thing is, we buy investment properties really to help fund retirement. I mean, that's one of the primary reasons people borrow to invest in property, of course. So if I'm going to go and buy an investment property, but my plan is, and in this person's situation, in 25 years, so it's some way down the track, in 25 years, I'm going to actually occupy that property, then whilst I will enjoy the negative gearing benefits of holding on to that property, sort of defraying the holding costs, if you like, it's not going to make a contribution to my retirement. So that's the first thing that I want to think about, because if I need it to make a contribution to my retirement, I need to be investing not only in that asset, but maybe other assets like property assets, maybe a share portfolio, or maybe super, or maybe all those sorts of things. So that's the first thing to really think about. The other thing I would say is that if someone approached me and said, look, Stuart, in 25 years, I want to live in this location. This list is written about, in an apartment down the beach, close to cafes and shops and so forth, and I'm going to go buy that property now, I would say, look, I don't think that's a great idea. A lot can happen in 25 years, not only in your personal situation and your personal preferences, but also in the location that might be attractive today, but less attractive in 25 years' time. So I think in your strategy, particularly if you're renting at the moment, so you're not living in your home, you need to consider how you're going to afford to go and buy that property. So you need to think about what would it cost today and then project forward what will it cost in the future. And you want to have that amount of money after tax to be able to make that acquisition. So you certainly need to map it into the plan, but I don't think I'd go and execute and buy that asset today. The only proviso there is if I wasn't making any compromises, if I thought the property was investment grade. So if it would otherwise make a fantastic investment property, then you could go and buy the property today. And if you then sort of pivoted and changed your approach and go, well, that's just a pure investment property now, I'm never going to occupy it, then so be it. At least you can count it as an investment. But I'd caution you, because let's not sit back and try and convince ourselves that the property is investment grade, because sometimes or mostly it's not, particularly if we're attracted, to a location for other reasons, other lifestyle reasons. So how would I, putting all that aside, if I just ignore everything that I've said, if I had a client that said, I'm going to go buy this property, I'm going to rent it as an investment property, 25 years, I'm going to occupy it, how do I make that work? What I would consider, I'm not saying I'm going to do this every single time, but what I would consider is to say, okay, let's go buy that property. Over the next 5 years, let's go and buy another property. We've got a 25-year time horizon here, which is good enough and long enough for us to enjoy some compounding capital growth. So we've got asset one we're going to keep and occupy one day, and asset two, but they're both investment properties for the next 25 years. In 25 years' time, I can sell asset two, pay the CGT, take that big lump of cash and repay the debt against asset number one. So sometimes the best approach in terms of strategic approach to reducing debt is to get more debt. Ironically, is to go and buy another property. And this is the longer time horizon you have, the less risky the strategy is. So you wouldn't do it if you're going to retire in 5 years' time, because that would just be, you just don't have enough sort of runway for that to actually work. But 25 years' time, there is enough runway for that to actually work. So what would I do in this person's situation, given I've said, don't go and buy the property that you think you might want to occupy in 25 years? Well, I would probably do something along those lines. That is, I would probably buy two properties with a view to potentially selling one or both to crystallize a large amount of capital, and I'm going to use that capital then to buy a home. And whether that home is, in fact, as the listener describes today, down the beach, close to cafes, shops, etc., fantastic. But if the listener changes their mind or their situation changes, then so be it. The strategy is flexible enough. Now, I said property because obviously gearing, you've got a 25-year time horizon. So I think a property asset, not because it's property, but just because of its attributes and your ability to gear and negatively gear, is probably going to be the most powerful assets here. But I guess you could use property and then eventually some gearing with shares, although it's going to be lower gearing. So over a 25-year time horizon, which is a nice, healthy, long time horizon, you're able to design a strategy, to my mind, that is less risk, because, the shorter time horizon, we're then really open to the vagaries of how markets perform in the short term, which is inherently difficult to predict. Easier to predict the weather, I think, than short-term market movements. But over 25 years, we should be in a position to make some pretty good plans with strong conviction. Anyway, thank you for your question, and hopefully it's a good enough response. Okay, next question is from Tosin. He writes, I came across your podcast second half of 25. After listening to a few episodes, I quickly realized the depth of value of each one and went back from the very beginning, and I've now caught up. Wow. Your holistic evidence-based approach has been foundational to my financial education. I want to sincerely thank you for the work you do. I've recommended your podcast to anyone that's willing to listen, knowing they'll gain real value from it. Thank you so much. I really appreciate it. That's awesome. The podcast is doing well, and certainly the ratings, and, just a little bit of a plug, if you want to leave a rating there, it certainly helps with the success of the podcast, and I greatly appreciate it. I read every, if you leave a comment, I'll read it. No, certainly know that. I'd certainly appreciate it. I would never go back and listen to the first. I should do it for fun, but I was recently asked on YouTube why I wrote a book many years ago called The Property Puzzle, and the thesis around the book was comparing different strategies, buy and hold, develop, commercial, these sorts of things. Anyway, I hate the book. I hate the front cover of the book. It's terrible. And I just hate the book. And I've said it a few times. People ask, why do you hate the book? The reality is that if I read anything or listen to anything I did for more than 5 years ago, I think, that shit, Stuart, you could have done much better today. Anyway, that's not me thinking from an ego perspective that I'm much better today, just that I don't like to consume any of my past work. So, but good on those. You do get quite often comments. I've listened to the back catalogue, which it's great. And I hope that most of the content that I produce is evergreen, and certainly the book Investopoly, which is obviously what the podcast is based on, and certainly Wealth by Design, which will be my next book out in the next few months. Certainly I like to write something so that it's useful today, and hopefully in 20 years' time when you read it, it's useful then as well. But so thank you, Tosin, for that beautiful feedback. So I better keep reading his question then. By way of background, my wife and I are turning 35 and 40 respectively. We have two boys, aged 6 and 4, both attending private school. Our household income is approximately $220,000. Our own occupied home is valued at 1.2 with about a 47% loan to value ratio. It's about 600 of debt, less than 600. We also have dual occupancy investment property worth roughly $1 million with an LVR of 95%, both on P&I repayments. Our medium-term goal is to upgrade to our dream home in around another 5 years, ideally in a better location, or stay in our current location. In the meantime, we are slowly sacrificing into super to get closer to the concessional cap each year. Longer term, our retirement goal is to generate $200,000 a year, with roughly 50% coming from super and 50% coming from property. I think of this as a two-factor financial authentication approach to retirement income. Our current investment property generates around $1,200 per week. Post-upgrade, we plan to acquire 2 additional investment properties within a decade, each averaging around $800 a week. Assuming rents broadly track with inflation over time, this would bring in gross rental income about $2,800 per week, which we estimate we could net $2,000 per week, aligning with our $100,000 property income target. However, after listening to your views, I understand you generally caution against relying on property for retirement income. Given our circumstances, I really appreciate your perspective on where the weakness or risks lie in our current plan, and whether there are more effective or resilient alternatives we should be considering. Wow, okay. Yeah, I don't like the plan. 50% of your income's not going to come from property. Firstly, you've got to repay all the debt. So that's the first thing that people don't really think about. Okay, go and buy all this property. I've got all this gross income. Yeah, but what about the debt? Now, remember, debt is a decision on how to fund an asset. It's nothing to do with the asset. So we can't, and sometimes investors conflate these two issues, and I do too, right? Because quite often I say, look, borrowing to invest in property is great when you're young and you want to build your asset base because you can leverage, and most of its return is in capital growth, which means that the tax drag is much lower because you don't have to pay tax, obviously, until you sell the property. So I'm conflating those two things too. And that's okay in some circumstances. Other circumstances, we've got to separate a decision on how to fund an asset from the asset's performance alone. So if you then want to say, okay, I want this property portfolio to throw off a lot of income, you then have to focus on repaying debt. And like I said, in the answer to the first listener's question, there's a level of debt, you don't want to repay all the debt. There's a level of debt that is efficient to really hold. The other thing is, if you model a property and a property's performance, you've got to be careful around rental income increases, expenses, and the other thing is land tax. So, and we model out over 30 years. Arguably, we might need to really change that and do it even longer just to see how it all works out. But sometimes if you do some financial modeling, you're predicting out 40 years, it starts to become kind of meaningless. It's so far out in the horizon, it starts to be a bit silly. Anyway, the thing that we see when we model property over 30 years, the net income starts to decline. So what happens is that we start off with an investment property and it's heavily negatively cash flow. In a strategy, we might put some debt towards debt reduction. So I'm not never saying, in fact, most of our strategies would have some surplus cash flow going towards investment debt reduction after we've repaid the home loan, of course. So some is almost always necessary, but it's not always necessary to reduce the debt to zero. In fact, often not ideal. So as the gross rental income grows and the interest bill falls because we're putting more and more money in the offset account, what we tend to see is that it's strong negative cash flow maybe for the first 5 to 10 years. Then 10 to 15 years, we start to see the property's cash flow be immaterial, and eventually it starts being neutral or even slightly positive. And then 15 to say 25 years, we start to see the income. It's okay. It's like in terms of dollar value, it's okay, but it's not shooting the lights out. And then after, or really between 20 and 30 years, we start to see that income decline again. And this is just based on our modeling. And the decline is because of the land tax. So land tax is insidious, right? You buy a great asset, a land heavy asset because you want compounding capital growth. That's fantastic. What you have to realize is that it'll produce less and less income for you because the expenses increase. The other thing we don't know, so when you look at rental growth across Australia, median value rental growth across Australia over 40 years, it's about 4.3%. So that's historically what it's been. You could probably describe that figure as around 1% above inflation. And it's around about sort of wage inflation, if you like. And I think that's probably okay. So you could probably assume maybe a 4% increase in gross rental income over time. But the increases in expenses are probably going to be more than that. You know, if you think about insurance premiums, council rates, expense, these sorts of things, they tend to increase by more than, just a few percent. And then, as I said, the land tax is the big one. So property is not an income asset. Certainly long-term, property is not an income asset. It's a capital growth asset. So Tossie, in your situation, what I'd say, yeah, sure, go and buy the investment properties, hold them for as long as you possibly can. That's good. You don't have to go and sell them all. Like the first listener's question, and it's probably something that I failed to share, is you don't necessarily have to sell them all. You might decide to keep one or two. If that person had 5, maybe, and I want to put more into super, maybe I keep one because he's got to put some more money towards the apartment upgrade, if you remember that question. So he doesn't need to go to 0 and you don't need to go to 0, but chances are you're better off taking the hit in terms of paying the CGT, putting that money firstly in a more tax effective environment like super, and then secondly investing in a way that's more liquid, that will give you more predictable returns. When I say predictable returns, I'm really talking about longer term, of course, but without the expenses. See, the problem with property is that you hope that the market does well, but the other way you can be hit is if your expenses rise, whether it's some crazy maintenance costs or, whether it's insurances going up, land tax going up. There's two kind of moving parts there that can really impact your investment performance. Whereas with the share market, it's really just the market will do what the market will do. Over long term, we get a sense of what it will do. It will do quite well. But also we've got some liquidity so we can sell down capital. And, we've got confidence over that sell down as well. So that's just my food for thought. I've gone over way too long. And tomorrow I'm going to talk about the policy risk associated with holding investment properties and how that I think has permanently changed for investors, government policy risk. And I'm going to talk about that and how to sort of navigate that and what that all means. Kind of relates to some of the stuff that I just sort of spoke about. So until tomorrow, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.